All right, today I want to talk about the Joe Biden proposal for taxes. And I think this is really important. Trump has recently surged in the polls and is getting close, but Biden is still predicted to be the winner in November. And we actually have an official tax proposal that is out there. And I'd like to go over it. I'd like to go over what possibly could happen and what changes we may want to make on our investment accounts, our retirement accounts, because of those tax changes. Now, I got my notes here. There's a lot to go through here with the Joe Biden tax proposal, and this is totally non-political. I'm just going to go over the actual tax proposal and how that might impact our clients and why you might want to make some adjustments to the investment accounts in the event some of this gets implemented. And so the first thing I want to talk about is the proposal to increase the top ordinary income tax rate. So if Joe Biden gets elected, he passes his tax proposal, he says he's going to increase ordinary income tax rates back up to what they were prior to when Trump had them reduced. And so there's a lot in between, but let's just look at the top marginal bracket. We have a 37% bracket today. It's going to jump up to 39.6. So not a big increase in the ordinary income tax, but it is a little bit of an increase. Obviously will affect those higher income earners and some of the people in between that will obviously get little increases in the middle. One of the things I want to note on the ordinary income tax, there's also a proposal here in California to increase the top tax rate here in California from the current 13.3% up to 16.8%. So currently, if we take the top ordinary income tax rate in federally and California, total tax rate is 50.3%. That will go up to 56.4% with both of these things. Now, I'm not going to go into the details. I know they're talking about a wealth tax here in California as well. For someone who has a substantial amount of money, for every $1 million above the cap, you have to pay an extra $4,000 a year in wealth tax. My understanding is that they want to tax people for 10 years after they leave California as well. So if they decide to move out, they'll continue to tax their wealth, their total net worth, which is a little different than income. It's your total net worth. And so that is the proposal. I highly doubt that 10-year thing will stand up. I don't think it's really constitutional. I don't think it'll get passed, but I know there's a lot of internet buzz on that. So I'm going to try to avoid that one because I don't think that that's going to go through. The capital gains and dividends. This is something, so besides ordinary income tax, you need to understand that people are taxed, different income is taxed differently. And so sometimes when you hear a politician say, I'm going to raise tax rates, they're talking about one type of income, in not all income. And this is important for you to understand. Ordinary income tax is paid by workers. There are people that are working for a living. So when we talk about ordinary income tax increase, the 37 to the 39.6%, that is your income from working, also from pensions, also from IRA distributions. But it doesn't count capital gains and dividends, which is taxed separately. So there's an argument that a lot of people are making. They say, wait a minute, you raise income taxes way up. Yeah, you're going to collect more income tax from the higher income earners, but maybe those income earners spend all their money and they don't invest in assets that throw off capital gains and dividends. And so those people that are sitting on a bunch of assets, a high net worth, maybe they're paying a much lower tax because they're not paying income tax, they're paying capital gains and dividend tax. And so this was an argument we heard a lot, and Joe Biden proposes to fix this as well. So his solution is to raise the capital gains and dividends tax rate. Currently the top bracket is 23.8. Most people pay 15%, but at the 23.8 would go all the way up to ordinary income tax rates, which in this case is 39.6%. So that's a pretty substantial increase in capital gains. How capital gains works is in the event you buy something, maybe a stock or a rental property, and it goes up in value and you sell it, this is the capital gain that you have to pay. So under the old rules, 23.8, new rules 39.6%. So that's a pretty big jump. Now I also need to point out that the state of California does not recognize capital gains. They just tax ordinary income tax on capital gains anyway. So we have to add both of them together. So the current capital gains rate, you have to put the 23.8 plus the 13 0.3 together. And so that gives us about 37% tax currently at the highest amount for capital gains. That is going to go up to 39.6 federal plus 16.8 state. That gives us 56.4%. So over 50% on the capital gains. And so that is a big change where capital gains and dividends would be taxed the same as ordinary income tax. Obviously, the thing that to point out here is in the event Joe Biden gets elected and you have a lot of capital gains that are sitting maybe in a rental property, maybe in stock investments, it may be a really good idea to sell those assets between November 4th and December 31st so you can pay a 37% rate instead of a 56% rate. That's a huge difference. And so you may want to realize those capital gains. And some of you might be thinking, well, I'm just never going to sell. I'm just going to die and I'll get a stepped up basis. But Joe Biden has changed that as well as part of the proposal. He wants to eliminate the stepped up basis, which we'll get to in just a second. So ultimately, you would always pay it no matter what, even if you pass it on to your beneficiaries. So another tax that he's planning on increasing is the corporate tax rate. The corporate tax rate currently is 21%. He's proposing to bring that up to 28%. So also, state of California has taxes on corporations as well. That's currently 8.84%. So currently, if you look at the numbers, 21 plus that, it's about a 30% tax that corporations pay at the high end, the high marginal rate today between federal and state. And that will go up to 37%. Not a huge increase, 30 to 37% for corporations. But it is important to note that corporations are actually double taxed. So you have the corporation paying the tax up front at the corporate level. Then when it goes to the shareholders, they get the dividends or they get the capital gains if it's a stock buyback. They then have to pay another tax. So you got the corporation paying the tax and you have the shareholder paying that corporate capital gains and dividends tax. So the combination of the two is really steep. If we take a look at a 37% tax first, so say a company has $10 in revenue, then they have $9 in expenses to pay for all their employees and their buildings and all their capital and cost of goods, and they have $1 in profit. So $1 in profit. Well, 37 cents immediately goes out in taxes to the state and federal. So you're left with, in this case, 63 cents. Then on top of that, you've got about a 50% tax on the up to a 56% tax on the remaining amount. So that leaves you with about 30 cents. So on a dollar profit at a corporate level, the shareholder that ultimately gets the dividend is going to collect about 30 cents. And that, of course, is the highest marginal rate. So that's very important to understand. One of the things they're talking about on the corporate tax is to have what's called a minimum corporate tax. Now, they don't specify what this is yet. It's just on there that they will basically put a minimum corporate tax. And this is where they're taxing revenue instead of profits. So you have some companies that are out there. I'll give you an example, like Uber is a company that doesn't have any profits. So they bring in a lot of revenue, but by the time they get done paying all of their drivers and paying for their marketing, everything they do, they don't make any money. So there is no tax because corporate tax is a tax on profits. It's a tax on gains. Well, they want to change that, so now it's a tax on revenue. So even if a company is losing money, they also have to pay tax. And so those companies would then have to take on additional debt in order to pay the tax, even if they're not profitable. So that's important to point out. We don't know what the minimum corporate tax rate will be or where those thresholds will be. They didn't specify in the official release. But that's something to take a look at. One of the big things that he's proposing is an elimination of the step up in basis on debt. Now, what the step up in basis is in the event that you buy something, a stock or a piece of real estate, and you die, your beneficiaries that inherit the property, they don't pay any tax on the gains. Joe Biden's proposal eliminates that step up in basis. So the beneficiaries, the people inheriting the property, would still owe the capital gains tax. So for example, I'll give you an example of my parents. They bought their house in 1974 for $29,000. Today the house is worth maybe around $600,000, and so that's a sizable gain. If my parents were to pass away and leave that house to me and my sister, all of that gain would be tax free, and this is called a stepped up basis. Well, now under the new proposal, that we would now have to pay tax on all of that gain. And of course, that tax would be at the higher capital gains tax rates, up to 56%, which is what a lot of people would pay on an inheritance, because it would be all at once, a long time frame for the capital gains to grow and build up. And so this obviously presents some challenges for financial planning, estate planning, because we may want to be in a situation where we're realizing some of those capital gains now while you're living, rather than waiting for them to build up and create a big tax problem for the beneficiaries. And it's pretty substantial. Let's say that someone had $600,000 in cost basis. This is what they paid for their house, for their rental property, for all their stocks. And over the years they bought in, they got $600,000 in cost basis, and the current value is $1.2 million. Okay, so you got a $600,000 gain. Well, in the event that you pass away today, the entire $1.2 million goes tax-free to your beneficiaries. Well, under the new proposal, now $600,000 would be taxed. So let's say it's at the highest marginal rate, 50%. So $300,000 in taxes would be due. That's $150,000 per child. Let's say there's 2 children. So the 2 kids that were $600,000 in inheritance are now going to get $450,000, right? So now you're in a situation where it's a lot less in income or a lot less in inheritance for the beneficiaries. One thing I want to point out on this, there was no mention of the inheritance tax, and this is unusual, because if you're going to get rid of the stepped up in basis, I can't imagine they would keep the inheritance tax as well, because this would be an additional tax on top of. Now, this only affects people that have estates over 11.58 million. Married couples, it's all the way up to 23 million. So you're in a situation where people that are above that threshold, now that not only do they have to pay this capital gains tax, which is up to 50% between state and federal, 56%, but now we have an additional 50% tax on top of that. So it's not a total of 100%, it's 56% on this chunk, and then what's left would be an additional 50%. So you'd be left with maybe 25 cents on the dollar, maybe less, 20 cents on the dollar from inheritance above that 11 million. Now, of course, the challenge that for people on this is people that own valuable pieces of real estate that they want to pass on to beneficiaries, or people that own businesses. And the businesses is a big deal, because we'll probably want to make some changes to how you handle businesses in the event this was to get put through, because typically people build up businesses and build up the benefits of the business, and they keep it as a really strong and profitable business to pass on to their heirs. But now if the heirs have to pay a ton in taxes at that time, it may be better off selling the business beforehand and realizing those capital gains up beforehand over time, versus just passing it to beneficiaries and having a huge tax problem from a business. And so ideally we want to take a look at the business and what that could be sold for, and potentially avoid that situation. One other thing that they propose is the elimination of the 1031 exchange. So part of the official release on Joe Biden's tax proposal is to get rid of the 1031 exchange. And for those of you that don't know what a 1031 exchange is, this is where if you own a piece of real estate, and it's only good for real estate, you can't do this with stocks and other things. So if you have a piece of real estate you buy and it goes up in value, you actually have a rule that allows you to sell that real estate, go buy another piece of real estate that's more valuable, and you can defer all of the gains you made on that first property, and you can move the gains over to the new property and continue earning income and tax deferral. And so ideally, if you keep doing this for the rest of your life, when you pass away, all of the asset gets stepped up for your beneficiaries, and then they don't have to pay any tax on all those capital gains. And you can really build up a really nice real estate empire for your kids this way on a tax advantage basis. But if we eliminate the 1031, now if you were to sell a property and go buy another piece of real estate, you'd have to pay tax at the time of the sale. So let's say you bought a place for $200,000, went to $400,000, you got about $100,000 tax you'd have to pay. So if you sell the $400,000, you're only going to get $300,000 to reinvest in the new property. So this obviously is going to make it far less lucrative to sell and trade up to other properties. you may want to just keep the existing property that you have and not sell. Now, one of the things that is a concern is if you don't sell, you obviously are going to just keep that property. The capital gains will keep going, but then eventually it's going to be a big capital gains tax for the beneficiaries that inherit this property because there is no more stepped up in basis. So the combination of no 1031 exchange and no stepped up in basis is going to mean substantial taxes for inheriting assets. So that's all really important. Now, one of the other things I wanted to mention, which was not on the official release, but Joe Biden's been talking about it. He's been doing speeches about it. I was surprised it wasn't in the official release because this seems to be one of the tax proposals he seems to be really pushing. And that is the elimination of the payroll tax caps. And so what a payroll tax is, it's a separate tax that people pay that are working into Social Security, Medicare, all these different social programs. And it's really, they say that this money is going into Medicare and Social Security, but it's really fake. All the money essentially goes in, the general fund is used, and there is no trust fund. Okay, it's IOUs, it's an accounting trick is all it is. The money that's collected from the payroll tax goes directly to general revenue. And then, of course, they pay for Social Security and they pay for Medicare and all these things. So this tax is actually paid by both the employee, which they see on their paychecks being reduced, and it also is paid by the employer, which is very simple. The employer could potentially be paying that employee a lot more income if they weren't paying their employer share. So essentially, the employee's income is reduced by about 16%. On their income up to $137,000. So this is like an extra tax that workers have to pay for, and it's supposed to be for Social Security and Medicare benefits. Now, this extra payroll tax of 16% is only paid up to $137,000 today. That's the cap. So if you make income above that level, ordinary income, you don't have to pay the payroll taxes, only up to that point. And it's only on ordinary income. So capital gains, dividends, other assets, you don't have to pay payroll tax on these things. Your pension that you get, you don't have to pay a payroll tax. Your 401k distribution, you don't have to pay a payroll tax. The proposal that I've heard over and over again is they want to include all of these other things, all this other income, to include payroll tax. So in other words, you add this payroll tax, the 16%, onto, if you're collecting a pension, you're collecting an IRA distribution, you're collecting Social Security, anything else. I'm sure there'll be some kind of exemptions and maybe some thresholds that you have to be above a certain number before they start taxing some of these other things. But they definitely want to eliminate the cap, the $137,000, so someone who makes more than that has to pay that additional 16%. And so this is in addition to all of the ordinary income taxes. So that's kind of all of the things that I wanted to cover on the Joe Biden tax proposal. And hopefully you got something out of it. But clearly we want to probably make some decisions in the event that Joe Biden gets elected on November 4th. And at this time, the current polls show him ahead. And we want to potentially take a look at the investment accounts and say, what should we be doing specifically between November 4th and the end of the year? My hope is if the 1031 exchange goes away, maybe we'll have a year where they'll kind of give us let us grandfather in people. So maybe we'll have a whole year where we can actually do 1031 exchange. I don't know. So it's not specified in the proposal in the official release. So anyway, hope that gives you some insight into the tax proposal that is out there and how that could potentially impact you. Any questions, feel free to reach out to our office and we'll be happy to chat with you further.